Gold and silver are vanishing from dealers, and nobody's reporting it. Physical demand exploded 250% while media says markets are stable, central bank stockpile, dealers ration. Delivery times stretch to months. I tracked the data for 2 weeks, and what I found is alarming. Subscribe now because this investigation changes everything. The 250% surge didn't come from retail investors or coin collectors. It came from a very specific source. Institutional buyers and sovereign entities suddenly shifting from paper contracts to physical metal. Between February and March, verified demand for physical gold and silver jumped from baseline levels to triple-digit increases numbers not seen since the 2008 financial crisis when trust in paper assets collapsed. Here's the anomaly. Futures markets show stable pricing and calm trading volumes, yet physical premiums, the extra cost to buy actual metal, have spiked to 15-20% above spot price. That gap is abnormal. In healthy markets, premiums stay around 2-5%, and think of it like this. Imagine concert tickets listed online at $100, but every seller demands $120 cash in person. Something's broken in the pricing mechanism. The unanswered question: why are sophisticated players suddenly willing to pay massive premiums for physical delivery when screens tell them everything is fine? Their behavior suggests they see risk the public data isn't showing. The premium explosion is the clearest warning signal. Spot prices on trading screens show gold around $2,750 per ounce. But try buying physical bars from dealers and you'll pay $2,900 or $3,100. That's a 10 to 18% markup, far beyond normal transaction costs. During the 2011 precious metals peak, premiums stayed under 6% even during heavy demand. Today, with supposedly normal market conditions, premiums have doubled or tripled that threshold. The divergence reveals a fracture: paper markets price based on contracts and leverage, while physical markets price based on actual availability. Think of it like grocery store signs advertising milk at $3, but every carton at checkout rings up at $5. The shelf price becomes meaningless. Here's the red flag. Major bullion banks that typically arbitrage these gaps aren't closing them. They're letting the spread widen, suggesting they either can't source physical metal easily or won't commit inventory. Why would institutions with billions in capital leave easy profits on the table? Warehouse reports claim everything is stable. COMEX vaults show millions of ounces available, but the classifications tell a different story. There's a crucial difference between registered and eligible metal. Registered means available for delivery. Eligible simply means it's stored there, often owned by private parties with no intention of selling. In early 2020, registered silver inventories dropped 70% in just 3 months when delivery demand spiked. The adequate supply narrative collapsed overnight. Today, registered inventories are falling again while eligible stocks stay flat. The math doesn't work. If demand truly surged 250%, withdrawals should reflect that movement. Instead, reported numbers barely shift. It's like a bank claiming healthy reserves while quietly limiting withdrawals. The books look fine until customers actually want their money. The open question remains, are these inventories real and accessible, or are they contractual obligations spread across multiple claims on the same metal? Central banks aren't just buying gold. They're buying physical gold at the fastest pace since 1967. China added 225 tons last year. Poland, India, and Turkey followed aggressively. These aren't speculative trades. Sovereign nations don't accumulate physical metal unless they distrust the financial system holding paper alternatives. The anomaly? These purchases accelerated precisely when Western institutions claimed inflation was cooling and markets stabilizing. Their actions contradict official narratives completely. Hedge funds show similar patterns. Filings reveal major players reducing paper gold ETF positions, while increasing allocations to vaulted physical metal. They're paying storage costs and insurance premiums they previously avoided. Think of it as wealthy passengers quietly moving toward lifeboats while the captain announces smooth sailing. Their feet betray what their words deny. The question haunting analysts: what do these accumulators see coming that justifies the cost and complexity of holding physical assets over convenient paper claims? Delivery times tell the truth that reports hide. 18 months ago, physical gold and silver orders shipped within 7 to 10 business days. Today, major dealers quote 6 to 8 weeks, sometimes longer for popular products. Some have stopped accepting large orders entirely. In 2020, the same pattern emerged before COMEX nearly broke. Delivery delays stretched, allocations shrank, and eventually certain products became unavailable at any price. The red flag now: mints are rationing dealer allocations despite running production lines at full capacity. The U.S. Mint recently confirmed limited releases due to blank supply constraints, yet mining output remains steady globally. It's like a restaurant with a full kitchen. telling customers the wait time is 3 hours. Either demand overwhelmed capacity or something else is consuming supply before it reaches the public. The unsettling question, where is all this metal going if retail channels face shortages while official inventories claim abundance? History offers 3 clear warnings. In 1980, the Hunt brothers' silver squeeze exposed how little physical metal-backed paper contracts. Prices collapsed when rules changed overnight. In 2008, gold entered backwardation. Futures traded below spot prices, signaling immediate physical demand exceeded future promises. Banks scrambled to locate actual metal. Then 2020 revealed the modern fracture. COMEX spreads blew out to $100 per ounce between paper and physical gold. The system nearly failed because delivery demands exceeded available registered inventory. Each crisis shared identical early symptoms: surging premiums, delivery delays, and official denials. The pattern repeated because the underlying structure never changed. Paper claims still vastly outnumber physical ounces. It's like watching the same bridge crack 3 times without repairs. Eventually, traffic doesn't just slow, the bridge fails completely. The uncomfortable question, are current signals early warnings of another breaking point, or has the system already crossed into irreversible stress? The threads now connect into a single picture. A 250% demand surge meets exploding premiums. Warehouse numbers don't match withdrawal patterns. Central banks accumulate while retail faces rationing. Delivery times stretch beyond explanation. Every signal points toward the same conclusion. Physical supply cannot meet accelerating demand. Historical precedent suggests a timeline. In past dislocations, visible stress lasted 18 months before breaking points forced market resets. Current patterns began emerging 8 months ago. The window is narrowing. The catalyst remains unknown. A major delivery failure, a currency crisis, or a geopolitical shock could trigger the final phase. But the foundation is already cracked. Think of it as pressure building behind a dam. The exact moment of failure is unpredictable, but the physics guarantee an outcome. What they're hiding isn't complicated. The paper system has promised far more metal than physically exists. The evidence trail leads to an unavoidable conclusion. Physical precious metals demand has surged beyond what official narratives acknowledge. Premiums, delivery delays, inventory anomalies, and institutional accumulation all confirm the same reality. A structural shortage is developing beneath calm surface prices. Central banks understand this. Hedge funds understand this. Major dealers limiting allocations understand this. The question isn't whether the paper-physical gap will close. History proves it always does. The question is timing and severity. Those waiting for mainstream confirmation may wait too long. By the time headlines acknowledge the fracture, premiums will have already priced in scarcity. The bounce back is real. The hidden stress is measurable. And the resolution, when it comes, will reward those who followed the evidence rather than the narrative.